The world's largest gold reserves, global gold, beneath our feet. Across the world, some of the most powerful financial assets are hidden far below ground. Vast quantities of gold are stored in secure underground vaults, out of sight yet central to global power and stability. These vaults are not symbolic remnants of the past, but active components of today's financial system. Gold continues to influence trust between states, central banks, and global markets. The fact that this gold remains largely invisible highlights an important reality. In modern finance, control matters more than visibility. What truly counts is who owns the gold, who can access it, and under what conditions. Why gold still matters. Gold remains a monetary reserve precisely because it is physical, finite, and independent of political systems. Unlike digital or paper assets, it cannot be created at will or devalued by policy decisions. Physical ownership builds confidence, especially during periods of crisis. Vaults holding gold therefore reflect geopolitical priorities and long-term strategic thinking. In recent decades, transparency around these holdings has become increasingly important. Trust today is built not only on ownership, but on proof, clear reporting, audits, and verifiable presence. Gold matters because it can be proven to exist. From vaults to power, gold directly links finance with sovereignty. Decisions about where it is stored and how it is managed influence markets, diplomacy, and perceptions of national strength. In many cases, silence itself is intentional. In global finance, actions taken quietly often speak louder than public statements. Gold is power, expressed without noise. United States, three fortresses of gold. America's gold structure. The United States officially owns one of the largest gold reserves in the world, and this gold is not stored in a single location. Instead, it is distributed across several highly secure sites, including Fort Knox, West Point, and Denver. Each of these locations serves a specific role within a broader security strategy. By spreading its gold across multiple vaults, the United States reduces physical risk and ensures redundancy. This structure reflects long-term thinking, where resilience and protection are prioritized over convenience or visibility. Fort Knox may be the most famous, but it represents only one part of a much larger system. Fort Knox and the myths. Fort Knox has become almost legendary, surrounded by decades of speculation and conspiracy theories. Questions about whether the gold is really there have appeared repeatedly in public discourse. To address these doubts, the US government has occasionally allowed public and political visits to the vaults. These visits were not formal audits, but symbolic gestures. They were meant to reassure the public that the gold exists and remains secure. In reserve management, perception matters. Confidence in physical presence supports trust in the system itself. The New York Fed distinction. A crucial distinction is that the Federal Reserve Bank of New York does not store U.S. government gold. Instead, it holds gold for foreign countries and international institutions. This highlights the difference between ownership and custody. The New York Fed functions as a global liquidity hub, not as America's personal vault. Germany. Transparency as strategy, gold after World War II. After the Second World War, Germany stored a large share of its gold reserves abroad rather than domestically. This decision was shaped by the political and security realities of the Cold War. Storing gold in countries such as the United States, the United Kingdom, and France was seen as safer at the time, reflecting Germany's dependence on allies and concerns about geopolitical stability in Europe. While this arrangement offered protection, it also meant that Germany had limited direct access and control over a significant portion of its reserves. For decades, German gold was secure, but effectively in exile. Repatriation to Frankfurt. In 2013, Germany announced a major policy shift. The Bundesbank decided to bring a substantial portion of its gold back to Frankfurt. Hundreds of tons were repatriated from abroad, and the program was completed ahead of schedule. This operation required careful logistics, coordination, and trust between institutions. Beyond the technical success, repatriation restored a stronger sense of sovereignty and direct control over national reserves. It also responded to public expectations for greater accountability. A new standard of trust Germany went even further by publishing a complete list of its gold bars, including serial numbers and weights. This unprecedented transparency strengthened public confidence and set a new global benchmark. Trust was no longer asserted, it was demonstrated. China, quiet accumulation. Official gold, growth. China has steadily increased its officially reported gold reserves over recent years, often through regular monthly additions. While there have been short pauses in reporting, the overall direction remains clear and consistent. By the mid-2020s, China's reported gold reserves had exceeded 2,300 tons, placing it among the world's largest holders. What stands out is not the speed of accumulation, but the persistence. This approach reflects long-term planning rather than reactive behavior. China signals its intentions gradually, allowing changes in reserves to unfold over time without dramatic announcements. Signals beyond headlines. Official reserve figures only tell part of the story. Import data provides additional insight into China's gold demand. Flows through Hong Kong and other global trading hubs reveal sustained underlying accumulation, even during periods when official numbers remain unchanged. Domestic price premiums also indicate strong internal demand. For market participants, these physical movements often provide more reliable information than public statements. In the case of China, markets tend to watch what moves rather than what is said. Strategic objectives. China's gold strategy supports several long-term objectives. These include diversification away from US dollar assets, protection against sanctions risk, and strengthening confidence in the domestic financial system. Silence, in this context, is not a lack of transparency. It is a deliberate strategic choice. IMF, Italy, and France. The IMF's gold role. Although the International Monetary Fund is not a sovereign state, it is one of the largest gold holders in the world. Its gold reserves originate from historical member quotas and past transactions and form a structural layer of stability within the international monetary system. This gold is not actively traded or used for speculation. Instead, it serves as a long-term credibility anchor, reinforcing the IMF's ability to act as a financial backstop during global crises. The presence of gold on the IMF's balance sheet supports confidence in the institution's independence and its capacity to respond when member states face severe financial stress. Italy's transparent model. Italy provides a clear and well-documented example of how a country communicates its gold strategy to the public. The Banca d'Italia openly explains why gold is held, where it is stored, and how it is regularly audited. Approximately half of Italy's gold is stored domestically, while the remainder is held abroad to ensure liquidity and market access. This balanced approach strengthens both national sovereignty and operational flexibility. Transparency in this case is not just informative, it actively builds credibility. France and reserve continuity. France has maintained large and stable gold holdings for decades, with very few abrupt changes. Its strategy emphasizes continuity and preparedness rather than frequent adjustment. Gold functions as sovereign insurance, ready to support financial stability in times of crisis. This long-term consistency highlights gold's enduring role in national balance sheets.